Many investors find tax efficiency one of the most appealing aspects of owning ETFs. I think that's particularly true now given the low rate environment that we're in, because the benefit of tax efficiency, or of not having any capital gains distributed from your investments, is that you get to keep more of those returns yourself. And if you look at the iShares products, we've been at this for a long time and have a lot of expertise in how to manage the products to really achieve the optimal tax efficiency. And for 97% of our products over the past 10 years, we haven't paid out any capital gains distributions at all. So investors, again, are able to defer having to pay taxes on those investments. It's important to understand where that tax efficiency comes from. So for an ETF, it's really like a hybrid between an index fund and an individual stock. And the tax efficiency comes from both places. So as an index fund, the ETF is tracking a particular index as a passive investment, which allows it to be very tax efficient. But it also has an additional benefit being an ETF, because investors are trading ETFs with each other, and that also leads to more tax efficiency over time. So one interesting example of tax efficiency is IVV, which is our iShares that tracks the S&P 500. And if you look at it over the past 5 years, IVV has outperformed 68% of all of the other large cap blend funds. But if you look at it on an after-tax basis, it's actually outperformed 78% of all the large cap blend funds. So it really kind of brings to life this feature that allows investors, again, to keep more of their investment returns until they decide to sell their investment. It's also really important for investors to really look at the structure of the ETF before buying. iShares ETFs are organized on a standalone basis versus other types of ETFs that have more of a multi-class structure that could create some risks for investors in terms of future capital gains distributions. Taxes can also have a negative impact on investment returns over longer periods of time. Lipper did a study ending in December 2009 looking back at a 10-year period that showed that the tax impact was between 1 and 2.1%. So if you think about that compared to expense ratios, the tax impact can actually be larger than the expense ratio itself in some cases. So tax efficiency is just one of many benefits that ETFs offer to investors, but I'd really encourage you to do your homework, understand the differences between ETFs, and really understand how they can benefit your overall investment portfolio.
Regarding the example citing the performance of iShares S&P 500 ETF, IVV, percentages are survivorship adjusted and account for merged and liquidated funds over the time period. Analysis is based on the oldest share class of active open-end mutual funds to avoid double counting of multiple share classes. After-tax calculations are based on a 35% investor tax rate assumption for income and short-term capital gains and a 15% investor tax rate assumption for long-term capital gains. Actual after-tax performance depends on the investor's tax situation and may differ. Past performance does not guarantee future results. Transactions in shares of ETFs result in brokerage commissions and generate tax consequences. ETFs are obliged to distribute portfolio gains to shareholders. Dedicated share class ETFs are standalone products made up of a portfolio of securities and have a single expense ratio with fund expenses, including transaction costs, distributed pro rata across all ETF shareholders. Shareholders are insulated from the transaction costs and capital gains created by other shareholders. Multi-share class ETFs are a distinct share class of an existing mutual fund and are a share of an investment pool invested in a portfolio of securities. Each share class has a unique expense ratio, and fund expenses, including transaction costs, are distributed pro rata across all shareholders, including potential costs incurred by other share classes. Scale may reduce these costs. Transactions of mutual fund shareholders may create tax efficiencies by creating additional tax lots. However, redemptions may also create capital gains distributions that are distributable to ETF shareholders. Call 1-800-iShares to request a prospectus, which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Investing involves risk, including possible loss of principal.